Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now, where was your first vacation trip this year as the world emerged from COVID restrictions? My family and I had initially planned on traveling to Bali, but skyrocketing flight ticket prices revealed that many others had the same idea, and we diverted to Phuket instead. Now, Bali is clearly returning in popularity, and this past week and weekend it was the site of the G20 Finance and Central Bankers meeting. Now, this meeting ended without a consensus on key issues and didn't issue a joint statement. Hence, this week we'll be focusing instead on three key upcoming events that we believe are set to shape markets this week. Now, the first one is the ECB policy meeting with the central bank scheduled to set policy rates this week. Now, consensus is looking for a 25 basis point rate hike, taking policy rates to negative 0.25%, with the bigger rate hike as being unlikely in our view, with one research report that came across my desk this morning noting that the ECB has generally not hiked outside of what is largely priced by markets. Now, what may be of more interest than the headline policy rate, though, is any details on the proposed anti-fragmentation tool. Now, political turmoil in Italy over the past few days has brought the market's attention back to the risks higher policy rates and widening spreads between German and Italian government bond yields could pose to the financial stability of Italy and the rest of peripheral Europe. A relatively credible set of details could help reduce some of these worries, help contain the spread between the two bonds, and offer a little bit more support for the euro. Besides, of course, creating more headroom for the ECB to consider raising rates more forcefully if it feels the need to do so. Now, that's in Europe, but the second key event, of course, is the Bank of Japan policy meeting towards the end of the week. Here, the central bank and inflation data have both offered almost no grounds to expect any policy changes for now. Now, this is likely to keep the downward pressure on the Japanese yen in place, as the Bank of Japan policy remains in sharp contrast to that of major central banks elsewhere. As we discussed in one of our earlier podcasts, a test of the 139 to 140 level for the dollar-yen currency pair is likely in the very short term, at least until we see stronger signs of a peak in the US dollar. Now, this brings me to the third key event for this week, which is the US earnings season, with reports by US companies really starting to pick up momentum this week. Now, to set a little bit of context, markets are currently expecting earnings growth of around 5.6%, which is down slightly from estimates at the start of the quarter. Now, this headline expectation does mask quite a lot of dispersion across sectors. So, for example, if you exclude the energy sector, earnings are actually expected to have fallen slightly in Q2. Now, what we would focus on more closely, of course, is the evolution of corporate guidance on the impact of high inflation and economic weakness, particularly on corporate margins. Now, in the US, our sector preferences continue to be for energy, financials, and the healthcare sectors. Oil prices continue to be key for the energy sector, and as we discussed in Through the Noise on Friday, demand concerns are likely to be offset by a still very tight demand-supply balance for now. For financials, there have been some concerns from earnings reports thus far on rising bad loan provisions and, of course, falling capital market activities. But we expect rising margins from higher rates to be a key source of support, especially if guidance on loan demand holds up. Finally, the healthcare sector offers relatively defensive exposure, coming from relatively dependable earnings growth and relatively lower sensitivity to the economic outlook. So overall, several sector opportunities we see, as we watch the ongoing US earnings season, and of course, we see opportunities from a potentially still weaker Japanese yen, at least in the very short term. So we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.